Thank you all for coming. For those of you who don't know me, my name's Malcolm Cook, and I'm the Program Director for East Asia at the Lowy Institute. And I'm very happy to be announcing today's Wednesday Lowy Lunch for a couple of reasons. One, of course, it's dealing with one of the largest questions facing both the world, East Asia, my area of interest, and Australia, how China, now by purchasing power parity terms, the world's second largest economy, and before this crisis, and probably during this crisis, the largest single source of world growth, how are they dealing with what for them will be one of the most significant economic shocks they've had since in the 30 years of opening up? This is the 30th anniversary of China opening up, as well as numerous other anniversaries this year, including the 60th anniversary of the founding of the People's Republic of China. And luckily we have one of Australia's kind of leading scholars and experts on Chinese political economy, Leong Liu from Griffith University, who's part of their business school and head of their international economy and Asian studies section. Second reason I'm very happy is the publication that Leong wrote for us that's free on our website, calling Dealing with the Inharmonious World. Chinese foreign policy is trying to create a harmonious world as well as a harmonious society domestically. This is a bit of a challenge in today's definitely inharmonious global economy. This is the second publication for the Griffith Asia Institute, Lowy Institute project looking at the future of China. So I'm particularly proud that Leong's come down from Brisbane. Thank you very much, both because it's a huge topic and because it's a sign of the Lowy's Institute's kind of networking in the rest of Australia and our ability to bring voices that might not be heard but are definitely worth listening to. So Leong, please.
Thank you, Malcolm, and thank you to all of you for coming to listen to me. I first got interested in China when I was a student, and due to two books actually, Edgar Snow's book on Red Star with China and Mark Evan's book on the pattern of Chinese past. And I first went to China in 1978, and I've been back every now and then since, and I actually spent 3 years there as an exchange student in the early 80s. And for many of you here who have actually worked on Chinese issues or who have followed events in China over a long period of time, just when you think that you know China, something comes up and you find out that, well, I don't really know China. So, before I start, having said that, before I start my talk, I want to issue a caveat, right? We know that China is still very much an opaque society at the best of times, and with this crisis, things move so quickly. And it's very difficult to say with any great certainty what's actually happening or would happen in the future. So my warning is that you should therefore treat what I say today like what the market today is, what it is pricing the, let's say, the December forward rate of the Australian US dollar, right? We know that this forward rate, changes as we approach the maturity date, and it's very likely to be different from the actual spot rate in December. So my advice is don't rush to buy or sell your BHP or Rio shares on the basis of what I'm going to say today, right? Most probably, have to be revised. Okay, I'll start my talk by asking, okay, what role did China play in the crisis? So many people have written on this, and I will not deal too long on this issue. But I will highlight a few points that have been ignored or not examined closely by previous commentators. And for those who have read the Australian papers and other international papers, you find that the proponents who blame China for the crisis point to the global imbalances and argue that these imbalances are the result of China either manipulating its currency to keep it below the market level or below the equilibrium level, and or saving too much, and by corollary, the US not saving enough. Now, the first point about China's exchange rate can be dealt quite easily. When we look at the numbers, it tells us that the yuan had appreciated 21% against the US dollar from 8.28 yuan in on July 21st, 2005, when they depegged its currency, to 16th of September 2008, the day after the collapse of Lehman Brothers. So it has actually appreciated 21.4%. And if you look at the impact on the US-China trade imbalances, it's really have not much of an impact. And if you look at the academic research on this issue, there's actually no consensus. There's no really any agreement as to, whether the Chinese currency is seriously undervalued. The latest research by the National Bureau of Economic Research in the United States found that in 2006, the yuan was undervalued by only 10%. But, leaving that issue aside, right, this question, right, what impact has it had on the deficits or the surpluses of countries, US and China? If you think of the appreciation of the Chinese yuan, it actually has two impacts, right? One, of course, it reduces the domestic price of exports, but at the same time, it also reduces the price of the imported inputs. And it's well known that about half of China's exports are based on triangular trade, where the final processing and assembling of exports from China's OECD neighbors is performed in China for dispatch to markets in Europe and North America. And the result of this triangular trade was that China's trade surpluses with North America were the engine of growth for countries like Japan and Korea. And if you look at the value added then of Chinese exports is actually quite low, the domestic value added of Chinese exports. The latest estimate based on 2006 figures, it's about 50%. So it's for every dollar that Chinese export overseas, only about 50 cents of that actually originate from Chinese value added, from Chinese production. The other 50% are imported inputs. And in fact, the earliest studies support this finding by the people at the National Bureau of Economic Research. Some of the earliest studies, like the one by Professor Lau, in 2006, he actually estimated that the value added of Chinese exports to the US was only 37%. And it's much lower, right, than the 87% domestic value added of US exports in China. So because of this triangular trade, right, the changes in the exchange rate doesn't really have that great an impact on Chinese exports. And if you look at what happens, right, on the ground in China itself, the impact of this appreciation, what you find is that although you have this appreciation of the exchange rate, between 2005 and until 2008, what you find is that on the ground, the exports are not that affected. And in fact, what you find is that the real wages have actually gone up during this period. And if you look at the evidence, what you find is that during 2001 and 2007, the average real wage growth in China, this is manufacturing or industrial wages, actually went up by 12.9%. So despite the appreciation, Chinese real wages went up 2001 to 2007 by 12%, 12.9 actually to be precise. And if you look at other countries like the United States, similar type of labor, the real wage growth between the same period actually went up by 0.03%. And if you look at a country like Germany, it went up by 0.51%. This is per year over that 7-year period. And what you find is this, right, is that the exchange rate, right, is only one variable determining your competitiveness. The other variable, important variable, is your domestic cost. And labor cost is a very important component of the cost of producing Chinese exports, because Chinese exports are mainly very labor intensive. And so what you find too is that the labor market in China is extremely flexible. So, and wages in China respond to the exchange rate. If the exchange rate appreciates too much, then the growth in Chinese wages will be slower, will be smaller. So there's this compensation effect. So the bottom line is that just by, even if China were to manipulate its currency, they can't really control the real exchange rate, the competitiveness of Chinese export. They can influence it, but only to a limited extent. So what you could see is that despite Chinese real wage growing by 12.9% a year between 2001 and 2007, you find that the trade surplus with the US continued to grow. So the exchange rate is really not the issue here. But what you find is that there is a focus, I think, a tendency of focus on the exchange rate in the West. And I think it's because in the West, labor markets tend to be fairly rigid. And therefore, the nominal exchange rate becomes a useful policy instrument, because when you change the exchange rate, you can actually change your competitiveness. Whereas in China, when labor markets are highly flexible, it's not as easy. Okay, now, the next point about the saving investment imbalance is actually, it's a more complicated. Well, I'm not going to, delve into the argument as to whether, the United States should blame, their generous host, in this case, China, for their hangover, that is the global financial crisis, the day after the New Year's Eve party, that is the boom, right? Or should we blame the police or the regulatory or rating agencies who were not there on the street to check on the drunken drivers, or who were there but were working with defective breathalyzers? We don't know about the poor rating agencies, the work that they did, the poor methodologies, and so on. So we're not going to look at this. But what I like to point out is that even if you assume that there's something in this saving investment imbalances, it's only half the story. It's not a full story. Sure, China is part of the story. Now, what is the other part? What is the other half? Well, the other half is actually the major oil exporters to the United States. Now, Canada and Mexico are the two major exporters of oil to the United States that are not members of OPEC. Okay? Now, I didn't really actually know this until I actually look at the data. The US actually imports more oil from Canada than from Saudi Arabia. Okay? Now, if you add the trade deficits that the US has with Canada and Mexico with its deficits with OPEC, you will find that these deficits of the US exceed those it has with China. 39% versus 33% in 2008. And an interesting figure, if you look at the historical data, is that, in fact, the trade deficits with OPEC, plus Canada, plus Mexico, grew at a much faster rate than its deficits with China. In 1998, it's a good year because we know that it's the year of the Asian financial crisis. The total share of these oil exporting countries in US deficits was only 19%. China's share was 25%. So in this about 10 years span, this period of 10 years, the US deficits with these oil exporting countries actually increased by 20%, 39% from 19%, whereas in China it was 23% from 25%. So in fact, if we want to look at the global imbalances, China is only half the story. The other half is the oil exporting countries. Now, if you, okay, look, what is the explanation for this? Well, in a way, it's pretty obvious, right? It's a low price of gasoline in the United States. If you look at the data for January 2009, the average end use per liter price of gasoline in the United States was about 1/3 the prices in France, Germany, and Italy. And the reason for the difference is actually taxation. These countries impose a tax rate of more than 200%. In US, the tax rate is about 30%. So imbalances, there may be a story there, but China contributes only half the story. Okay. And in fact, those of us who have visited the US, I mean, I'm sort of making this comment, it's a bit, it's a bit facetious, but I think it's quite interesting observation. If you go to the US, you observe everything is big, right? Big cars, big houses, big restaurant servings, big people, right? That obviously has some impact on the import of oil, energy. Okay, now, so it is a challenge, right? These imbalances, China, assuming it is a problem, can play a role. Import more, export less. Buy more, save less. But the U.S. also has to play its role, and it's a challenging role for the U.S. Oil, the addiction to oil. There's another problem in these imbalances too, is that if you look at the trade imbalance or the saving investment imbalance in the U.S., it's really started with the last Bush administration. Right? Last Bush administration raised real federal spending by 4.9% per year, and most of it actually went to defense, which registered a real annualized rate of growth of 8.1%, compared to 4.9% per year under Lyndon Johnson. And Lyndon Johnson administration actually financed the Vietnam War. So the issue then is, okay, if we discount the Obama's administration spending to counter the global financial crisis, the question then is how much scope is there for cuts in U.S. defense spending? Okay. So assume that the global financial crisis never happened. What scope would that be for the U.S. to reduce its consumption of oil and reduction in government spending? Okay. Let's go on to my next point or next question which actually would like to address is, are the global imbalances sustainable? We hear a lot that, that some commentators said they are not sustainable. Now, but I myself is not so sure that they are not sustainable within reasonable time span. Now, when a country runs a deficit, it either borrows or it sells its fixed assets to surplus countries. Conversely, a country like China that runs a surplus will either lend, buy U.S. securities, for example, or buys assets from deficit countries, foreign direct investment. So current account imbalances, can be balanced by capital flows. China doesn't have to buy U.S. goods; it can buy U.S. assets, right? So it can run down its surpluses or foreign exchange reserve by buying assets. Doesn't have to cut down its exports. I mean, theoretically at least. Okay. Now, in 2007, if you look at the FDI data that's available, the world FDI outflows total 2 trillion. China's share was only 2.25 billion, just 1.1% of the total. Australia actually had a larger share, 1.2%. All right. So, and the largest shares of, as we would expect, belong to the EU and the US, 57% and 60%. And if we look at China's share of accumulated FDI, the stock of FDI, or the stock of assets that's managed to, overseas assets that managed to purchase over a period of time, its share of accumulated FDI outward stock is only 0.6% as of 2007. Australia's share was actually 1.8%. Now, a solution to the global imbalances is available, right? Which, from the Chinese perspective, it's quite attractive, is that through FDI. But the question, of course, would be, will deficit countries like the US accept this solution? All right? Now, as we know, we need two parties to do a tango, right? You can do the twist on your own, but you need another person to tango with, right? Now, we need deficit countries to welcome foreign direct investments, and we need the surplus countries that are willing to invest. Now, recently, the China's Ministry of Commerce actually announced that it is making easier, it's going to make it easier for Chinese companies to make foreign acquisitions. And is actually leading its first mergers and acquisition delegation of corporate executives to Europe. Right? Now, but all I can say is, but don't hold your breath, right? As you know, the Chinese, badly burned by their investments in the US, and they will be very careful. And as we know too, Australia is a good example. There is aversion again in countries of selling the farm, so to speak. So even if China was prepared to buy, there's going to be problems whether countries are going to welcome their FDI. Okay. Now, I just changed tack a bit and ask now, okay, what has been the impact of the crisis on China? It's difficult to separate out the impact of the global financial crisis on China from other impacts on the Chinese economy. We're looking at the period 2007-2008. We know that in 2007, the Chinese economy was overheated. Inflation is measured by Consumer Price Index, peaked at 8.7% a year in February. Share prices boom. And the red chip stocks listed on the Hong Kong Stock Exchange, the stocks listed in Shanghai and in Shenzhen, all peaked at 2007. At the end of October 2007, the Hong Kong Red Chips Index value was actually 3 times its value in early January 2006. If you look at the Shanghai and Shenzhen stock, they were about 6 times. So it grew 6 times, multiplied by 6 during that short period. So obviously, there was this huge asset boom occurring in China. The Producers' Price Index grew to a historical high of 10% or rather the inflation, the growth rate went to a high of 10.1% in August 2008. And in September 2008, when it's obvious that the global financial crisis is in full swing, the Producers' Price Index still grew by 9.1%. Now, the global financial crisis hit China just as attempts by Chinese policymakers to cool the economy began to work. The People's Bank of China had increased the reserve requirement ratio 6 times in 2008, with the final increase occurring on the 25th of June last year. And it went up to 17.5%. And they actually increased it to 17.5 after only increasing it to 17% 6% 10 days earlier. So obviously they felt that the economy was running ahead of them. The PBC also increased interest rates. But there's something interesting here, is that it's interesting to note that the People's Bank of China, that's a PBC, did not increase its official rates in 2008. Instead, in 2008, while it was trying to cool the economy, it actually increased its reserve requirement ratio. That is the amount of reserves that the commercial banks had to set aside and not lend to customers. Now, one plausible reason, and this is a commonly accepted one, is that the People's Bank of China did not want the higher interest rates to attract hot capital inflows, thereby putting upward pressure on the yuan. But there's also a suggestion that the increase in the reserve requirement ratio actually kills two birds with one stone. Number one, avoid upward pressure on the yuan, but also moderate the increase in official foreign exchange reserves. And there's some discussion or talk among certain circles that there is an informal agreement between the major banks, major commercial banks, where the state have a majority shareholding, that the PBC and these banks have an agreement that part of the reserve requirement ratio should be in foreign reserves. Now, the Chinese banks are not allowed to borrow overseas, so the only way in which they could get the foreign currency to meet the reserve requirement is to buy from the foreign exchange market, which means it moves the foreign reserves out of the People's Bank, right? So it wouldn't be listed as official reserves, right? Now, Logan Wright, who actually wrote a thesis on Chinese exchange rate policy, estimated that for every 50 basis point increase in reserve requirement, that is 0.5%, the banks would have to purchase $18 billion US. So that's one way to, in a sense, by increasing this requirement ratio, you reduce the official data on foreign reserves. Because as we know that foreign observers look at the foreign reserves in the PBC and say, your foreign reserves are increasing at too fast a rate. Appreciate the exchange rate. So there's some suggestion that by shifting a lot of the foreign exchange reserves out into the commercial banks, there'll be less pressure for China to appreciate. I have to say this, though. The evidence is circumstantial, right? It's no concrete yet, but there are some people believe it, and it's a plausible story. Okay, now the beyond monetary policy, policymakers did a few things, to stop the boom at the time. They raised the stamp duty on share transactions, and the New York Times also reported that Beijing actually resorted to the use of satellite pictures to detect unapproved construction projects to rein in investment in the provinces. And the National Development and Reform Commission played a major role in reining this investment. And that's why they weren't too popular with local governments last year and got a bit of a hit during the reshuffling of responsibilities in the 2008 National People's Congress, because they were trying to cool the local investment. Now, while endeavoring to slow the economy in 2007, the policymakers were also embarking on restructuring on restructuring the economy to make the Chinese economy less dependent on low value-added, low-skill manufacturing, and by implication, less dependent on the traditional exports, which tend to be low-skill, low value-added. Now, in one sense, the policymakers were forced by necessity, right? The currency is appreciated, Real wages have gone up, right? As I mentioned before, between 2001 and 2007, real wages actually went up by 12.9%. This would be industrial wages. But there's also something else, and that is there's also a belief among the senior leaders that China is to be recognized as a major economic power. It should be known as a significant manufacturer of high-tech, high-value-added products, and not as the world's factory of low-cost, low-tech, low-value products. So this idea, China has awakened. We're going to take our rightful place in the world. And we shouldn't really be doing this, be well known for doing this, producing this cheap stuff, right? Okay. We should be producing the high-tech stuff. And we might recall that actually in Singapore, during the last crisis, in the Asian financial crisis, actually just before the Asian financial crisis in the 80s, the Singapore government actually adopted a similar policy. They actually actively encourage increase in wages to try to shift production away on low-cost manufacturers. And just as they were unfortunate, China was also unfortunate that the financial crisis sort of hit at about the same time. And there were other things that the policymakers, Chinese policymakers did to try to execute this structural change, reduce export rebates to low-value products. And at the same time, they also passed a law, the National People's Congress passed a law that grants increased rights to workers, limits temporary employment, increased job security.